Ratio analysis. Financial ratios are mathematically comparison of financial statements, accounts, or categories. This relationship between the financial statements account that help investor, creditor, and internal company managements to understand how well a company is performing and area of needing improvement. Financial ratios are the most common and widespread tool used to analyze a business financial standing. There are seven types of ratio, which is liquidity ratio, solvency ratio, efficiency ratio, profitability ratio, market prospect ratio, financial leverage ratio, and coverage ratio. First is liquidity ratio. Liquidity ratio analyzes the ability of a company to pay off both its current liability as they become due as well as their long-term liabilities as they become current. In other words, this ratio shows the cash level of a company and the ability to turn other assets into cash to pay off liabilities and other current obligations. Liquidity is not only a measure of how much cash a business has, it is also a measure of how easy it will be for the company to raise enough cash or convert the asset into cash. Next is solvency ratio. Solvency ratio is measure a company ability to sustain operations indefinitely by comparing debt level with equity, asset, and earnings. Solvency ratio show a company ability to make payment and pay off its long-term obligation to creditor, bondholders, and banks. The most common solvency ratio include debt to equity ratio, and debt ratio. Next is efficiency ratio. Efficiency ratio, also called activity ratio, measure how well companies utilize their assets to generate income. Efficiency ratio often looks at the time it takes companies to collect cash from customers or the time it takes companies to convert inventory into cash. In other words, it's make sales. These ratios are used by management to help improvement the company as well as outside investor and creditor looking at the operational or profitability of the company. Efficiency ratio go hand in hand with profitability ratio. Profitability ratio. Profitability ratio compare income statement, account, and categories to show a company ability to generate profit from its operations. Profitability ratio focus on a company returns on investment in inventory and other assets. Next is market prospect ratio. Market prospect ratio are used to compare publicly traded companies' stock price with other financial measures like earnings and dividend rates. Investors use market prospect ratio to analyze stock price trend and help figure out a stock current and future market value. Next is financial leverage ratio. Financial leverage ratio, sometimes called equity ratio, is measure the value of equity in a company. This ratio compare equity to asset as well as share outstanding to measure the true value of the equity in a business. In other words, the financial leverage ratio show the cost of equity and the amount of investment the shareholder has made in the company. Lastly is coverage ratio. Coverage ratio are comparisons designed to measure a company's ability to pay its liability.